The Forex market is divided into various access levels, based on the size of the transactions. The main participants in this market are governments, central banks, commercial banks, investment funds, pension funds, and private investors. Governments have many reasons for controlling the value of their currency, and they usually do so by holding the debt of another state, or a large portion of their reserves. It is good for governments to have a debt with another state, because this ensures that their currency does not depreciate too much. If the United States of America borrows $50 trillion from China, China will want its money back, and as a result China has a vested interest that the US dollar does not depreciate too much. It is all a game of strategy on which the world economy is based. Central banks are the most important participant in this market together with governments. Central banks have the power to decide whether to raise or lower interest rates, and the market as a result will immediately start moving sharply. The central banks we refer to are the Federal Reserve System, the European Central Bank, the Bank of Japan, the Bank of England, the Bank of Canada, the Reserve Bank of Australia, the Reserve Bank of New Zealand, and the Swiss National Bank. Commercial banks are the famous market makers, also known as those who create the market. Commercial banks are important participants, who can move price as they wish. They control large amounts of money, and can open positions that cause important continuation or reversal price movements. The large commercial banks issue the largest transactions in the Forex market. Investment funds and pension funds are organizations that manage huge amounts of capital, provided by private clients and the government. These funds speculate a large amount of money in the market, creating profit for themselves and for their clients. Investment firms and pension funds invest trillions of dollars using a conservative approach. In fact, their purpose is to protect the accumulated capital and guarantee the payment of pensions. These two participants do not influence the daily fluctuations, but when they decide to enter or exit a position, they can generate large trend reversals, taking away or adding liquidity to the market. Large private speculators who open multi-billion-dollar positions can have a concrete impact on the price movement of currency pairs, and this also applies to retail traders with large amounts of capital, such as the famous George Soros, which invests in currency pairs with multi-billion-dollar positions. By entering the market with positions of this size, you can certainly influence the direction of the price. Commercial traders are participants who do not speculate in the daily fluctuations of the Forex market, but use the market as a tool to hedge global deals and a potential devaluation of the currency in which they place their interest. Commercial traders use a trading technique called hedging. Multinational companies like Google, having offices all over the world and paying salaries in different currencies, convert huge amounts of different currencies each month, which can also influence the movement of the market. Another influential participant are the speculative companies, also known as hedge funds. In fact, hedge funds are companies that invest large amounts of capital, speculating exclusively on the fluctuation of the price of certain assets, holding positions for days, weeks, months, or even years. These companies have a strong impact on the market, and use an aggressive approach thanks to their experience and investment philosophy. Traders with smaller capital are called retail traders, and have no impact on the market due to insufficient liquidity. For retail traders, it becomes essential to understand the psychology of the market, technical analysis, and fundamental analysis, so that they can create their own trading system, following the main trend fluctuations created by the major participants in this market.